Hello and welcome. I'm Craig Finfrock, Vice President of Region 2 of CCIM Institute and the owner and designated broker of Commercial Retail Advisors in Tucson, Arizona. Welcome to today's webinar, CRE Opportunities in Region 2, the Resurgence of Secondary Markets. We're happy to share this webinar with everyone in the industry today. For CCIM members, this is just one of the many member benefits that are designed to help you adapt and thrive in 2021 and beyond. Joining us today is CCIM Institute Chief Economist K.C. Conway, CCIM CRE MAI. K.C. is going to discuss the factors that are bringing secondary markets and Zoom towns back to the forefront, including current trends, what's driving them, and how you can best set yourself up to tap into the CRE opportunities in our region. Please feel free to ask questions throughout using the Q&A tab. We'll be answering as many as we can at the end of the discussion. And if you're experiencing technical difficulties, please use the chat feature to ask for help with that. The recording and accompanying presentation will be emailed to all registered attendees. K.C., welcome and thanks for joining us today. I'll turn the show over to you.
Great, thanks, Craig. It's super to be with all of you guys and everyone in Region 2. So we'll just jump right into it here. Here's the cover slide. And as you all know, I'm going to start with kind of where we picked up maybe earlier in the first quarter. Many of you know through the mid-year meetings, I shared my annual anticipation with the different moving companies' annual migration reports. So we had both the United Van Lines and the U-Haul, and this is going to set us up here. So in your region, Arizona was number 5 in terms of the most net inbound relocations. California, you just can't catch a break there. They were, one of the top 5 for move outs, but we actually have some really good news to share about the California markets. The 2 reasons that were cited in the United Van Lines study on migration for a move were a new job or getting closer to family. That made sense with COVID and packing up and maybe working remote with mom and dad. But here's what's even more interesting. This was the U-Haul report. And again, Arizona was the only state to be in the top 5 of both the U-Haul and the United Van Lines. So when I see that, that tells me there's a lot of people moving to Arizona. Nevada, you were in the top 10 with number 8. And then close by in your region, Utah, which I've stated for quite a while, is an understated story what's going on there. California, I guess U-Haul just didn't like you. Maybe more people rented U-Hauls to move home with mom and dad, but you were the worst in terms of the most out migration. But we're gonna have good news here for you on that. So let's pivot and now look at we're getting some of the census data. And what is the census data telling us? The 2020 census data. It's either consistent or inconsistent with, say, the moving company migration reports. So if we look at that, look at how strong your region is. So Nevada, you had over 15% net growth in population. Arizona, New Mexico, very respectable. Arizona, almost 7%. California, for all the stuff they give you about people moving out, you had 6% overall population growth in the 2010 to 20 period. And hey, I hope Hawaii is paying attention. Look at the good news on Hawaii, 7% overall net in migration. So I know there's a lot of concerns about the out migration and move outs from Hawaii, but at least over the last decade, this was quite positive. Where Larry's at in Illinois just wasn't a good story. Illinois, West Virginia, Mississippi were the 3 states to lose population growth. But this is a very positive, I think, message for your region in the Inland Mountain region, Idaho, Nevada, Utah, Colorado, very strong population growth. A lot of that is coming out of West Coast markets where there's been affordability and other issues, but still very, very respectable. There's another piece I want you to look at called the American Legislative Exchange. And so they look at, the growth numbers, and they look at things like how much states spend, their deficit spending, whether they're fiscally balanced, how much they tax. And their hypothesis is that states that spend less and tax less experience higher growth rates. Well, let's look at that on the chart here. So Utah, number one, very consistent with a lot of other metrics. But look at Nevada, number 7. We generally don't think of Nevada, I live in the eastern United States, as one of those states that spends less, taxes less, and has a lot of growth. Look at Arizona, another very strong story, and especially compelling when you look at how kind of alone Arizona and Texas and some of the border states are in terms of dealing with our southern border and the migration problems down there. New Mexico, not as great a story, 38, and California, at least you weren't down there at the bottom with New York, New Jersey, and Illinois at 45th, but you also have a lot more people and infrastructure and issues to deal with. And we'll talk about one of them that is paying very good dividends, your ports of LA and Long Beach. So the Tax Foundation is another resource that I look at that looks at how well states are doing in terms of funding their pension liabilities. This is going to be an increasingly big story as people like me, us baby boomers, age out and want to have retirement benefits. So in your region, Nevada is performing the best. It's 77% of all of your pension obligations fully funded. That's remarkable. California, for all the dire news and about, fiscal budget problems and whatnot, look at where you're at. 72% of all your pension liabilities are funded. So likelihood you're gonna maybe keep some of those retirees around there. Arizona, very respectable at almost 70%, 67. And as well, if you look down, further a little bit in Hawaii, Hawaii actually has a fairly low at 55%. And I've got a footnote down here at the bottom just for Hawaii. When I was the chief economist for Colliers, I was fortunate enough to be able to come over to Hawaii twice a year. And one of our clients was Kamehameha Schools. And one of the reasons Hawaii gets a low number here is because the analysis by the Tax Foundation doesn't take into account Kamehameha Schools, trusts and trustees that oversee $9.5 billion in assets to help educate and serve the people of the Native Hawaiian ancestry. So you put that $9.5 billion back in the equation, in Hawaii, you'd be up there in the 70+%, approaching 80% range. So don't let them knock you down. Very important, if you don't know Kamehameha Schools, those in Hawaii all do, and the great work that they do and the history and the legacy there. But that's your good inside baseball story for Hawaii to rebuke any of this news from the Tax Foundation. All right. So pivoting off Hawaii, one of the things I'm going to go through here for each of your states in your region is some site selection analysis. Site Selection Magazine's one of my favorite resources I look at. They do really great, robust analysis on the different states. And so I'll pick up on Hawaii here. Now, Hawaii, they have you ranking last in terms of the lowest industrial electric power cost. I just want to say, no duh. When you're an island, state, it's very difficult to generate unless you have maybe tap into the volcanoes or some more wind power. But it's very, very difficult to have the kind of electric power generation that we might have, say, with Georgia Power or in the Texas region, or Duke Power in the North Carolina and the Southeast with very low rates. Or I just did Region 1, Seattle and Washington State has some of the lowest out there. So basically the message here is don't expect a lot of focus on a manufacturing economy for Hawaii. There's a lot of other things that are pretty good news about Hawaii. And here's the big one. So this is the leisure and tourism industry, and your University of Hawaii Economic Research organization does a great job, tremendous research and resource for all of you. So what I did here is I went on and I grabbed from them really the 3 headline economic forecasts from really going back to December 2020 when things were down, March of 2020 when we were really just starting the pandemic, and where we are currently. So let's start over on the right, the ugly. The entire state of Hawaii was shut down from leisure and tourism travel. You lost over 100,000 jobs. Unemployment went to almost 12%, and whatnot. But if you look at where we are today, don't jump quite to that yellow box on the bottom. Let's look at the middle, the bad. So the ugly was March last spring. The bad was December, the end of this year. And so it was really more hope that the vaccinations would work, the mainlanders would get vaccinated, and they'd use all their airline frequent flyer miles to come back and visit you in Hawaii. And what we've seen now in May is that's exactly what's happening. This shows you the dynamic, whether you're in Arizona with Phoenix, or you're in Southern California or Las Vegas, the power of the return of leisure and travel and what a difference vaccinations make. It's completely coming back. Hawaii lost 2/3 of its visitor expenditures, but now it's already back to 50% of the level of the pre-pandemic levels. So what I did is I put a chart there in the bottom. The green box is 2019, when things were going very well. 2021 is where we are today. The yellow boxes represent kind of how these key metrics changed. And the big one that I want you to look at is at the bottom, the visitors days and percent change. So you're up 120%. You're back to almost 63,000 visitor days. And in 2019, you were at 87,000. So my prognosis and outlook for Hawaii is very optimistic. And because most of the states in the mainland area is not going to be able to travel to Europe and Asia with us being vaccinated, and they're still having outbreaks and problems there, I think we're going to opt and we're going to splurge and we're going to go to Hawaii, especially if we've got some of these frequent flyer miles. So Hawaii is a quintessential example and one of the big beneficiaries of the success around vaccinations. Your leisure and hospitality industry is coming back very, very strong. And I think you have a great second half of the year to look at and a very solid next year to look at. So let's look at California. So California, here, we got to give you the bad news and the good news. We'll just get out of the way at the top. You rank 49th in terms of the Tax Foundation's ranking of state business tax climates. But we know you have a lot of expenditures that you've got to do on. But look at what you rank number 1 on. You're number 1 in higher education and R&D expenditures. Guess what? You invent things, you create things, you create all the technology and the cloud technologies and stuff that we use. It's just harder for those incubated companies to stay and remain in California when they grow or get incredibly successful. But being number 1 at higher education and R&D expenditures is a really proud accomplishment. I would put that out in all of your marketing materials and brochures. You see that the other metrics you rank in the in the bottom 5 or 10 of the nation, but that higher education and research expenditures is very powerful. So let's look at, and this is going to pivot into Arizona and some of the rest of your region here. Who are the top states for manufacturing? So again, site selection does this annual analysis, and the top 2 states for manufacturing activity and new manufacturing plants are South Carolina and Tennessee. And coming in after them are Texas, Alabama, Georgia, Mississippi, and North Carolina. But Idaho and Utah have moved into the top 10. And this is an amazing story for those of you in Arizona. You are about to become and are an electric vehicle manufacturing sleeper story out there. Really good news coming. Many of you know this story from earlier in the year, where the Vancouver, Canada-based EV car manufacturer picked Phoenix over Nashville, Tennessee. That is a huge watershed change and win for you guys, because Tennessee in the Southeast United States has been winning all the EV manufacturing plants, whether it's Mercedes or the recent announcement by GM this year, Volkswagen, Honda, Toyota, Mazda, Hyundai, Kia. They've all been in basically Tennessee, Northern Alabama, or Georgia. And so for you to knock that off is a tremendous recognition of a lot of things going on and going in the right direction for you to be a major player in electric vehicle manufacturing. And why that's important is these EV manufacturers don't want to have too much in one region of the country, and they're terrified of Tesla. So they don't want to be in Texas. They're nervous about being in California. And in Arizona, you sit in a perfect position to really benefit and compete against the Southeast United States. So really a good story there for Arizona. In terms of your site selection, you're kind of in the top 10 to 15 on a couple of items there. The bottom one there is fiscal health. This is one of the really important ones when you think of all the issues that you have to deal with the southern border and the illegal migration problems. For you to have this much fiscal health, it means you have dry powder to participate in some of that economic selection and incentives to bring entities like EV manufacturing your way. Number 18 is also impressive. Higher education and R&D expenditures are number 18 in the country. And when you think of some of the competition, that's an incredible accomplishment. Arizona State University, one of the leaders in additive and 3D manufacturing, which may have something to do with the EV electric automobile manufacturers looking so good at your state. You're also, because of fiscal health and affordability, I think to have these higher education and R&D expenditures are the seeds that are really going to result in germinating a lot more economic growth. So this is very good news for Arizona. Nevada, we're not going to leave you out. So if you look at, we're going to look at your number 7, because I think this is the most important one to look at in the bottom, number 16. 7 is the Tax Foundation's ranking of the best states for business tax alignment, and you rank number 7. And so again, a lot of people don't think about that. They think other places, Texas and Florida and North Carolina or Tennessee. And when you travel around the country, it's just not top of the mind to have Nevada, but it's a very impressive story. And all of us as CCIMs, we need to help tell that story about the states that maybe there's misperceptions about. And look at number 16, your fiscal health. So again, a very, very impressive, good story on the site selection side. And here's where you really knock it out of the ballpark. So many of you know, more than a year ago in Henderson, you got the announcement of this new additive manufacturing tools company, Haas, that was building a $327 million facility to create 1,400 jobs. That is underway. It's broke ground. But here's what's the impressive story and the economic seed that you've planted to germinate in Nevada. Your new advanced manufacturing rapid response training program is the centerpiece for more of this. And what you've done is you've really said something like what Huntsville, Alabama did a couple of 3 years ago. And they said, let's start teaching this robotics and additive manufacturing and modern workforce skills at the K to 12 level. So we have the workforce to go into the university systems. They're in Nevada and be there for the companies that need that workforce. So this Haas economic plant win is huge. And then what you guys have done with that in terms of the advanced manufacturing rapid response training program to really bring this skill set and education to the K to 12 level is very commendable. You're one of only probably 3 places in the country, Huntsville, Alabama, and Houston, Texas, with the University of Houston Community College. You're probably the only 3 that have really fully embedded and embraced and funded this type of education for tomorrow's workforce. So good job, Nevada. Pat yourselves on the back. So I want to look a little bit at housing, and this keys up to the kind of the title of this session, Moving to Affordable Zoom MSAs. And so this is a piece that's done by Rent Cafe, and I like it because they really have good, robust research going on and looking at what's happening with rental rates and housing affordability. And what they're finding is that many of our workforce are migrating and moving, like U-Haul was telling us, and the census was telling us, to more affordable markets. And when you look at kind of what Zoom has done during COVID, look at the inland markets. We're moving more inland than we are to the coastal regions, and we're moving away from high density and high affordability. 6 of the top 30 hottest rental markets are Zoom MSAs in your region. In California, this is impressive. That people don't always equate affordable with California in the same sentence, but your Central Valley, Sacramento, these are all regions when you look at the cost in LA or San Francisco that are relatively affordable for California and are really generating a lot of multifamily activity. New Mexico, look at Albuquerque, very popular market with a lot going on. Tucson, it's not just a Phoenix story for you in Arizona. And then Nevada, look at Reno, and then as well Arizona, you look at Phoenix. This is more that validation. You go with the moving company migration reports, you look at the census data, you start looking at taxation and fiscal health issues, and now you start to see that the housing story is responding. So housing is moving to affordable Zoom MSAs, and your region's a big beneficiary of that. Here's the bad news on housing for a lot of your region. We have just reached back to the peak or not so good home price to income ratio that was last achieved in 2006, right before the subprime mortgage crisis. And this elevates the concerns that we really have around affordable housing. We give a lot of lip service to it, but when it comes to actually implementing affordable housing at the local and state government level, they don't want it in their backyard. There's a lot of local resistance. And John Burns, maybe in California may know John. He's a great housing economist that I've been a friend with for decades. And he just put this piece out on that. And this is a warning sign to us that what we're experiencing in housing and this rise in home prices, it's unsustainable. It's especially unsustainable if the Fed has to start moving interest rates up in response to inflation, because we're all used to 3.5% to 4% mortgages now. So this is a warning sign on housing. So what's the government's response and the Fed and FHFA's response to the housing affordability problem? Rather than finding ways to provide new product and incentive product like for rent subdivisions or manufactured homes, they said, let's just kick the rent forbearance program down the road. It just got extended again now through September. And we're really not going to understand the impact of where we're coming out of COVID and affordability issues and Zoom MSAs until we really purge ourselves of these, addictive goodies to kind of help the Zoom or from the COVID economy. And so I want you all aware this has been kicked down the road. It was supposed to end in the first quarter, then it got moved to June, then it got moved to the mid part of this summer and now to September. My fear is rent forbearance is going to morph into rent forgiveness. And for those multifamily investors and capital sources and lenders, you better be paying attention. In fact, yesterday I read the first piece where they're looking at, FHFA is looking at and studying maybe allowing rent forbearance for households with incomes under $50,000 that were in rent forbearance. So I think there's a lot of bad news, and we don't know what we don't know yet in multifamily. So here's some good news. At the beginning of the year, I gave you 3 metrics I said to really watch that will tell us whether we really have what we're experiencing now, a robust second half of the year, or whether we kick this out into 2022. And so the 3 metrics were look at vaccination success. If you remember back in December and the beginning of January, on the heels of the November elections, we had a change in government. We had a complete cluster going on with vaccination logistics, and it didn't look very bright, like we could get our act together to be where we are today, where 50% of Americans are vaccinated. The others were the Tsa Passenger Count, were we traveling? And the third was the Castle office occupancy to see if we were returning to work. So at the top here is a contrast between January and current right now in terms of vaccination success by the Becker's Hospital Review. Look at on that left column how poor our success ratios were for getting the doses that states were receiving actually administered to people. It was in a 17 to 31% ratio. Now look at where we are. We're at a 79 to 98% ratio. New Mexico, pat yourselves on the back, a more rural state where it's harder to do vaccinations and outreach to, Indian reservations and more rural areas. You're essentially administering everything you get. You're at 98%. Nevada, 88%. That's why you're able to open up casinos and all your tourism industry. Hawaii, an amazing job, given that you're disconnected from the mainland, and it would have been easy for someone to forget to send the shipments over to you. You're at 86%. In Arizona, very, very respectable at 79%. Some of your numbers are skewed by the border problem and illegal immigration. So I think your organic and legal population, the numbers in the 80s. So great look on that. So we're done. We can almost declare the success on the vaccination. Not so in the world. So our leisure business is going to do more as Americans stay here and they travel domestically and within the states. So here's what a different 6 months can make. This was a piece out over the weekend by the New York Times, and they looked at the states that had fully reopened, not partially. And except for Oregon and New Mexico, every state has opened up fully. Whether it's mask issues and socially distancing and industries are all open. New Mexico, you've met all your hurdles, and I think it's just a matter of time here and some logistics issues that you're going through to make that happen. Oregon, not so much. I think it's going to be a while, and they've got other problems that are there. So doing very, very well in terms of opening up the states. Let's look at TSA passenger count. Remember, if we're not traveling and we're not flying on planes, we're working remote and we're not doing leisure travel. And that's what was happening the end of last year and even in January this year. We went from flying 2.5 million passengers a day pre the pandemic to just 85,000 in April. We climbed back to around a 500,000, almost getting up to the 1 million over the holidays. And then we had another pandemic outbreak because we all traveled when we said we wouldn't do it. But then we got vaccinated, and look at where we are today. Yesterday, we set a post-pandemic record of over 2.1 million passengers flying through our airports. That's within 100,000 of pre-COVID-19 pandemic outbreak. So we're doing really well. We're traveling. I've even started to fly again. I've done 3 or 4 airline trips to Florida and North Carolina and up into the Northeast region, DC, Mid-Atlantic. I've got 6 trips booked coming here in the fall. And my experience has been, except for the chaos at the Atlanta airport, all the other airports, it's working pretty well. The TSA is staffed. It's the airlines that are having trouble getting all the planes back in maintenance order and recalling the crews. And many of them are rotating to new planes they hadn't flown before, so they've got to go through training. So American Airlines is in particular one of the real problems. So might keep that in mind. So we're doing great success. This was a great forward-looking indicator that's proving itself out. The last one that's not so good. This is the Castle Systems Back to Work Barometer. This is the company that has all of our key card technology that we use to swipe to get in and out of office buildings and hotel rooms and everything. And they break it out on office. And we're still struggling to get 30% of us to return to the office. This is the best primary data that covers everything. And what they were telling us in early February was only about 24% were returning to work. The best markets were in Texas. The worst markets were in places like San Francisco. Some of the California markets, LA, you still had big shutdowns. And look at where we are right now. Just in the last week, we're only at about 29%. This number has to change, or we really have some systemic problems in the office market. And I believe we do. I believe we are not going back in droves to high density, high rise urban office buildings. The opportunity in office is suburban in those big markets, and it is secondary markets where we're seeing all the population migration and the moving migration. So I'm very bullish on suburban and secondary MSA office activity, and I'm not so bullish on the dense urban downtown markets, especially those that are still dependent on public transportation. So here's a few things to challenge and to think about, because I always try to triangulate a data point or a call on a property type or an economic metric. So Facebook earlier this week or end of last week announced that all employees are eligible to work remotely after the pandemic. That's a pretty significant bellwether. They also said something that employees weren't ready for, and that is if you move to a lower cost region, they're going to adjust your salaries. So if you move from LA and San Francisco or Seattle inland to Salt Lake or Phoenix, or Albuquerque, they know the cost of living is lower there, and they're going to adjust your salary. I think we're going to see a ton of litigation around that attempt by entities like Facebook. And this guidance going forward is that they expect that at least half the time people are going to be working remote. So if that's the case, we sure don't need the same amount of office space. So a number of entities have been doing a lot of studies around this and looking at what employees are saying versus what employers. And I found this very interesting, whether it's the Gartner survey, Mercer survey, Flex Jobs. These are all really good entities that do robust, credible research. And what they're telling us to predict from employees is the following. Almost a third, 28%, plan on looking for a new job that allows remote work if their current employer doesn't continue and allow remote work. That's huge. So when you think about our jobs opening and labor turnover survey, the JOLTS report, really pay attention to that. There's a reason we have 8.1 million open jobs, and it's not just because everybody's getting stimulus checks. A lot of them revolve around this remote work issue. So employees are clearly voting. If you need us and you want our skill set, you're going to let us work wherever the bleep we want to work. And so this is going to be important. Employers, what are they saying? 74% of chief financial officers plan to permanently shift at least 5% of their workforce to remote work. That's a permanent shift, not part-time. In Mercer, they found that 76% of companies will continue to allow flexible work, and almost half, 43%, will continue complete remote work. This is telling us both employers and employees are on the same page, And I think we have, when we look back 3 to 5 years from now, the property type that we're going to see was the most adversely affected by COVID wasn't retail, wasn't hospitality, it was office. A huge disruption going on in the office market. I think is going to play out for years here to go forward. The Economist also did a recent analysis, and they looked at it on a global basis as well as here in North America. And they found, this is a startling statistic, only 1 in 20 buildings in America, not globally, in America, had occupancy levels above 10%. I mean, 10% of the employees coming back to work. And that's pretty consistent with what that Castle Systems was telling us. We're just not going back to work. So Colliers did a recent report, and it showed that we have the most amount of sublet office space available for lease in the history of our country. It even breaks the 2008 to 2011 Great Recession numbers. So companies are already trying to give some of this stuff back. Companies are beginning to rethink their property needs, with many downsizing or delaying new leases. So let me give you CCIMs a tip. You're the first ones to get this. And that is, think about how to use site to do business, not just for retail property analysis, but office analysis. Because where these workers are going, or where the shopping and where the leakage analysis comes out in the community profiles, it's probably there and correlating to what's happening with the remote workforce. So I know I'm doing some work around it, trying to make sure that we think about site to do business with more dimensions than it's really valuable to us in the retail analysis world, and demographics and site selection. This could be an invaluable tool in terms of the office sector. And as CCIMs, that's a unique tool to us. It's unique, many of you in your regions. We're doing a lot of work around story maps. In fact, our new paper that got released this week on last mile logistics has a story map to it. So anyway, pretty good news on that side. So I'm going to pivot from office into logistics using Sam Zell. So in terms of Sam Zell, I'm a director, an independent director on a public REIT known as Monmouth. And we own and invest primarily big e-commerce logistics warehouses to FedEx and Amazon and the automotive industry and Home Depot and big retailers. And in May, after a long hostile action, activist investor trying to take over the company, Sam Zell came in with his EQC REIT, saw the value proposition in us, and we entered into an agreement to merge, probably be approved later this summer, maybe into September. But what's significant about this? Sam Zell's a CCIM. He's a pretty smart guy. He's done pretty well. And he said in making this move, he's pivoting away from office. He's going to orderly sell all of his office assets. And these are in really good markets in Austin and Denver and DC. And he's going all in on logistics. So if you don't think there's a watershed event going on between office and now shifting to logistics, use this as a proxy or a punctuation mark on that happening. So share that one with you. So I mentioned just a minute ago, the CCIM Institute, we got back to producing these industry insight papers. We didn't have one last year because of COVID. Our first one out is on last mile logistics. Here's the cover. Thank you to Larry Guthrie and the communications team for doing a good job. We had a little bit of disruption with Greg Fine's departure and Rich Rossfelter, but Larry and the communications team really stepped up to get this over the goal line. These are a lot of work. And I grabbed here and snagged a few of the headlines and topic areas that you might find. So I talk a lot about the Golden Triangle. And so Arizona, you almost nick that, but it's kind of where 80 to 85% of site selection and new manufacturing and new logistics infrastructure is going. It's really from the Great Lakes down to Texas, Arizona, and then all the way through the Southeast and Mid-Atlantic. And so you need to understand about that golden triangle. Also, we talk a lot about the voracious appetite for logistics assets and the prices that are being paid. That Monmouth EQC deal, it will reflect when it's closed, and it can be publicized, a cap rate for 120 buildings, all of them in secondary and tertiary markets that used to only be reserved for the LA, Long Beach, and Inland Empire market. We're talking sub 5%. So it doesn't matter now that you got to be in LA, Long Beach, Dallas, Atlanta, New York, Memphis, to get these assets at these prices. The prices that used to only go for Southern California are going across geography. Again, I mentioned we did a story map for this. Really our first time marrying up a story map with an insights paper. So we really want to get your feedback. And we drew on some other CCIM talent to help us out with that. And then really the story is finding speed and reliability in last mile logistics. And there are multiple models. There's a business to business model, a business to consumer model. There's the Amazon versus Walmart model. CBRE has documented what we've labeled RICS, retail to industrial conversion, taking closed big box stores like Kmart's and Toys R Us and Best Buy that are in really good neighborhoods where a lot of packages go into those dense zip codes. So some neat stuff and opportunities there for CCIMs. Here's California. This is the biggest bragging and the best story I can tell you about California today. Some of you may or may not know or follow your ports. You should. The Port of Los Angeles just broke a Western Hemisphere's monthly record for container movement. It broke a 114-year history at the Port of LA. They moved over 1 million containers in 1 month. So for all the grief and the complaining and the disparaging that's done by the Federal Reserve and the media about things are congested at the ports of LA and Long Beach, it's not all their fault. This is a global problem. And those folks, and again, you got to tip your hat to the labor workforce and the labor unions. They found a way to hunker down and achieve what has not been achieved in over a century. And so things are working very well at the ports of LA and Long Beach, but they can't deal with problems like a big container boat getting stuck in the Suez Canal, or one of the 4 largest ports out of southern China closing because of a new outbreak in COVID, or that they got to figure out how to handle all these empty containers from all the stuff that came in from Asia and now has to be sent back as empty containers. So this is really a remarkable accomplishment. Those of you that are Southern California, LA, Long Beach, Inland Empire, just look at that picture and think about the accomplishment here with all of the challenges around supply chain. There's another big supply chain story that we talk about in the new logistics paper, insights paper, and that is rail. Some of you may have been following that Kansas City Southern, one of our only 7 Class 1 railroads, has been in a volley between Canadian National and Canadian Pacific Railroad to merge. And it started with Canadian Pacific, and it's now flipped and looks like the deal is going to close with Canadian National. This has huge implications for our supply chain and our logistics, because Kansas City Southern was the only railroad that moved into Mexico and all its ports. You now partner that up with Canada, and look at Canadian National, the map at the top there. It really covers horizontally across all of Canada. So everything we need from potash and rare earth minerals and lumber and stuff coming in from Asia, Canadian National collects it. And it had been dropping it down into Chicago. It now can hook up with Kansas City Southern, and it can bring all those materials, those commodities and energy, and bring them all the way down into the Gulf region and into Mexico. And also from a reverse standpoint, stuff coming out of the Panama Canal and Mexico and South and Latin America can now move seamlessly from the Gulf all the way up into Canada. So this is a huge story. The map at the upper right shows you the 7 Class 1 railroads. I think Canadian Pacific is going to be forced to have to look at its own merger since it lost to Canadian National. And my bet is that it's probably going to take a close look at something like Norfolk Southern, which would allow them to bring everything in from Canada and move seamlessly through the mid-Atlantic and up into the Northeast, and really become the alternative supply chain for Baltimore and New York. So this is a huge story. We talk about consolidation in the logistics and supply chain industry. It's not just rail, it's also going to be in trucking and other logistics companies. The other thing that's top of the media news is whether we're going to get an infrastructure bill, and what's it going to look like. And are we going to spend $1, $2, or $20 trillion on what we broadly define as infrastructure? We need to be paying attention to this. The American Society of Civil Engineers produced a quadrennial report. They do this every 4 years on the state of our infrastructure. And they identified that we have huge needs. And although for the first time in 20 years, we got a passing C grade from a D, it was only because rail and ports got a B grade. Our ports and our rail are working very well, and everything else is broken and getting pretty much a failing grade. The White House has a fact sheet out. So this isn't political here that I'm providing you. And their fact sheet acknowledges that we have a $173 1,000 miles of major highways that are in complete disrepair. Yet the proposed infrastructure bill only deals with about 10% of that, 20,000 miles. It also acknowledges that we have over 45,000 bridges that are at basically the state of collapse, but they're only going to provide funding in this infrastructure bill for 10,000 bridges. So in the current proposed bill, only $1 in $5 go for real hard infrastructure. Infrastructure and keeping it up to date and modernized and expanding it is incredibly accretive for commercial real estate. It's something that we as an industry and CCIMs need to engage with our other colleagues and affiliates, whether it's the Counselors of Real Estate or National Association of Realtors. In fact, the Counselors of Real Estate right now is releasing its annual top 10 issues. And 2 of them I wrote and was on the committee to promulgate. And one of those is logistics and supply chain. So big story here. We need to be involved. We need to be paying attention on this. Here's another way that this industrial supply chain and logistics is playing out. For the first time ever, CBRE produced this report. Atlanta knocked off LA, Long Beach, New York, and Chicago for the most mega distribution facility transactions of over 1 million square feet. And this tells you what's happening with that golden triangle, the importance of infrastructure, fiscal responsibility. Now, LA, Long Beach, and the Northeast, you're still tied for 2. Dallas, Fort Worth in there at 2. But we are seeing more big square foot buildings being built, and they're not all in the Inland Empire in LA, Long Beach. So lots more opportunity in this space than just those of you in Southern California. Here's proof of that. This is a deal that's happening near Tuscaloosa, Alabama. I was on faculty there for 3 years. This is a deal that's part of our Monmouth portfolio. We will be the permanent buyer of this deal. It's essentially Mercedes EV logistics and battery warehouse and distribution facility for all of North America. It's being built in a little town called Vance, Alabama, near the University of Tuscaloosa. When this deal is done, the price that will be revealed and the cap rate paid will probably break every record outside of California. It may tie Southern California for the lowest cap rate and the most price paid. We're seeing these type assets now reaching $180 to $200 a square foot. And with the increasing importance of these buildings, the increasing construction costs, get ready, CCIMs, for $200 square foot plus warehouse transactions. That's great for commissions. These deals are tough and competitive, but this is one example of this happening, not in Southern California, not in Dallas, not in Florida, not in Atlanta, not in New York. This is in lower Alabama, the other LA. They used to joke all the time, come on over to LA, take a trip over here. It's the other LA. And I learned it was lower Alabama, not Los Angeles. So I included here, and I've done this in the last mile logistics course that the Ward Center produced with me back in January. These are some logistics and last mile resources to keep up to speed with if you're looking at doing more in this last mile and logistics and warehouse space. These are all very affordable. I read all of these every week. My favorites, the Association of American Railroads and their monthly rail traffic report. The Journal of Commerce and G Captain are phenomenal. So if you're in Southern California, if you're in a coastal market, San Francisco, Oakland, and on up the Pacific coast, you really want to be paying attention to these. All right, I'm going to bring us down a little bit here on the Fed and what they're calling transitory inflation. So many of you that know me know that I've learned after 35 years in the South, I grew up in Colorado, I've been down here a long time, that the polite way to say BS is barbecue sauce. It doesn't matter whether it's Memphis, Tennessee, or more spicy product, or North Carolina with more vinegar, or somewhere in between. So that this term transitory inflation is a made up term by the Federal Reserve. It really means, oh my God, we hope that we don't have systemic structural inflation like we had in the 1970s. And one of the problems and the causes for this is the Fed's balance sheet, its monetary policy and Congress's fiscal policy. We are out of control in deficit spending, and we're out of control in monetary policy. The growth, the chart here, is the growth in the Fed's balance sheet from when I was at the Fed in 2007, 2009. You see the growth, 2007, 2008, when I started, 2005 to 8 timeframe. The Fed's balance sheet was barely $1 trillion. And in response to the Great Recession, it grew to $4.5 trillion. It started to taper down with Yellen and when Bernanke left, we got it down to about $3.5 trillion before COVID hit. And in the last 9 months, the Fed has taken its balance sheet from under $4 trillion to now over $8 trillion. And the reason you need to understand that is the Fed doesn't produce, manufacture, or sell anything. So where does it get capital to grow its balance sheet? It simply calls the Treasury Department, which is closely related to the game Monopoly, and says print money. We've increased the money supply by over 20% in the last 6 months. This is devaluing the dollar, and this is what's causing a lot of real estate prices, whether it's homes or commercial assets, to go up so much as we're seeing capital spooked by things like Bitcoin going from over 60,000 down to below 30,000 this week, or what's happening in over 24 stock market indice record price levels just in this year, on top of the more than 24 last year. In a bond market, you want to own a bond in a rising interest rate environment. So capital is rotating out of other asset classes, Bitcoin, digital currency, equity, and bonds, and they're moving into real estate. And so we need to understand what's driving that so we can help explain it to our clients. I put up there in the upper left corner the remaining FOMC meetings. It'll be safe to go on vacation in August and enjoy trick-or-treating with your family, kids, and grandkids in October. You probably are going to be terrified in the September and the December meetings. September, we're going to come off the summer. We're going to have new data. We're going to have new earnings reports. We're going to see in those earnings reports from company, there's just systemic rampant inflation. And the Fed is going to choke on its words that they're not raising interest rates or culling the balance sheet back until 2023 or 2024. It's starting, the recognition that it needs to happen is now. They'll be tapering the balance sheet by the end of the year. And I will not be surprised if we don't see our first rate increase in the first half of next year. So the Fed can't find inflation, but I sure can, and the rest of the country can. And I just grabbed a few screenshots from just what I watch every morning between about 6 and 7:30 in the morning is CNBC, and I love the charts and the news and the people they bring on to interview. So Jamie Dimon was on June 14th, and he said that basically JP Morgan is hoarding cash because there's a very good chance inflation is here to stay. And so they're already expecting it at JP Morgan. Look at what happened in our recent producer price index. It's up over 6.5%. Look at the PPI, ex food and energy. Those are the volatile components. It was up almost 5%. Look at the CPI in the upper right corner, up almost 5%. This is systemic structural inflation. It's everywhere. It's not just in a few things. It really has correlations back to the 1970s. And what we need to think about is when this sets in, it really takes years to unwind. If we have chip shortages, it takes years to build new chip plants. If we have supply chain problems where we move manufacturing and supply chain distribution to other geographies, that takes 2 to 3 years to make the decision and build and move the new facility. So I put something on the bottom there I want you to think about. So look at the 10-year Treasury rate between 2018 and 2021 and think about inflation. So in 2018, we had a 10-year Treasury, the average yield hit almost 3%, and we had below 2% inflation. Now, we're running below 1.5% on the 10-year Treasury right now, and we are running 6% inflation. That 6% is almost identical to what we experienced 1977 to 81 that resulted in a 21% prime interest rate. So be thinking about why is our 10-year Treasury right now below 150 and not spiking when we have these inflationary pressures? And the answer is go back to the Fed's balance sheet and look at what the Fed is doing. It's intervening in the market and it's buying the Treasury bonds. It's artificially keeping these rates low so things don't implode in the housing market, constructions, and banks since they put all this capital in there. So it's an interesting thing to think about. Additionally, on inflation, one of my favorite resources is ENR, Engineering News Record. And so they actually produce, it's cost less than $100 a year to get. You get it digital and even cheaper instead of both digital and hard copy. And it's showing us where their construction is. They have a constructionomics section every month. They break out the cost of construction versus building costs. They have a city index. And so they've got I have a screenshot here, the East Coast ones, but they're small and large markets like in Atlanta and Boston is large and small as Birmingham. The same on the West Coast, LA, San Francisco, Seattle, you're all in this index. And look at these numbers. We all know the lumber story, up almost 300%. But look at copper, up 83%. But check this out. Paint. You want to repaint your house for the summer and do a little touch up? Paint prices. A gallon of paint's up almost 70%. Appliances are up over 65%, 2/3. Every element that goes into building a house is more expensive, everything that goes into new construction. And the reason why I want you to pay attention to this is if you're doing leasing or property management and you have tenants that want to expand or move, you're going to need to buy sheetrock, you're going to need to buy metal studs, to redo the partitioning, you're going to need to buy paint. You're going to need to buy a lot of the commodities. Carpet's almost a scarcity. You almost can't get it right now. And we have the carpet manufacturing capital of the world in Dalton, Georgia, here in north of Atlanta. You can't get these items, and the costs are up 50 to 100%. Be engaging with your tenants now about their budgets and be preparing them that the cost to move may be greater than the cost of a rent increase. And so really CCIMs are uniquely qualified to help make those decisions, those business decisions, those site selection. Do I absorb a rent renewal and a rent increase versus moving and maybe capitalizing? Think about the office. And if you're going to sublet your urban downtown stuff and it's going to take 50% of the rent to tenant improve it, and you're going to move to the suburbs and it's going to take almost as much to redo it, what do you do? So this is an opportunity for CCIMs to demonstrate their skills to clients. So adaptive reuse is another important topic we do, and many in your markets have many great examples of this. This is a new paper that my new company, Redshoe Economics, produced with a grant from the National Association of Realtors and the Florida Realtors on adaptive reuse. And adaptive reuse is moving away from just single asset eyesores in the city to looking at whole neighborhoods in suburbs or neighborhoods affected by a dark mall. And so we write about this, and I use other examples around the country. In Phoenix, I identified Marina Square near Arizona State University as a great neighborhood approach to that. In Denver, I used an example of the streets of South Glen of a suburban mall, completely redone using neighborhood zoning. So check that paper out. Remember, in 2018, it was the CCIM Institute that took on the topic of adaptive reuse, and we produced the signature initial paper that is still cited almost everywhere. I even see it in court cases where I'm testifying where it's cited. I mentioned today the Counselors of Real Estate right now is releasing its top 10 issues. 2 of those are topics that CCIM Institute has led on, and those are adaptive reuse and logistics. I authored and I was on the committee to produce why those are top 10 issues, and its roots are all embedded in the CCIM Institute. So that's at the end. This is my company. It's a little bit about my partners. I learned two things about, at age 58, becoming an entrepreneur for the first time in the middle of a pandemic. The first thing was surround yourself with good people and partners like a fellow CCIM. So Beverly Keith from North Carolina, past president of the North Carolina chapter and serving in many leadership roles at the national level. She agreed to take me on as a project. I said, if we're going to start this company, I want to walk the walk on ESG. And I said, I'm going to be the only one of me. I'm going to be an aging white man with graying and thinning hair. And so we are a majority woman-owned minority business. I encourage all of you, the importance of ESG is going to be a big deal. Call that type of stuff out. I'm showing you an example of how simply I do it that gets the attention of different entities and customers and clients because they're making decisions around whether your company, your brokerage is perceived as having good ESG. These are some of the services we do. We're going to have hopefully a new CCIM, Kaylin Peterson. She's part of our team. She's going to be taking the exam in Pittsburgh. She was part of one of my co-authors on the adaptive reuse paper. She's a whiz on story maps. So if you need some help there, contact Beverly and we'll get you fixed up with Kaylin and help you do that. So with that, I want to thank you and I'll turn it back and see if we have time for any questions or discussion.
Wow, thank you, K.C. That was a lot. And you never cease to amaze me when I watch and listen to you, all the information, and it's constantly changing. We're living in such crazy times, and having information like this is at our fingertips is essential, and just raises more questions. And we've got a few here, and let me just go to a couple of them if you've got a few minutes.
So how about we get rid of the first one that's always there? It's kind of like the ubiquitous ladder in the road during rush hour. Yes, the slides will be made available. And
Okay.
we're already working on
Yeah.
this. We got one done.
Okay, thank you. Yeah, I know, because you have to go back and watch it again just to catch all the stuff. It was coming at us so fast. And I really like looking at the PowerPoint slides because there's so much information in those slides that you don't even touch on. I mean, it's just there. And I could spend an hour doing that. So, with you made a point about the Port of Los Angeles or Long Beach just setting a record. And, we have such a shortage in materials and manufactured goods. Is that going to help ease that up? Are we going to start to see prices? Is that going to have an effect on prices and help our growth?
So I wish I had a good answer for you to say yes, but unfortunately the answer is no. In fact, I would tell you, start doing your Christmas shopping now, because we are going to have shortages of goods, not because they couldn't be manufactured, but because they couldn't be moved through the supply chain. It's really encouraging that our ports like Port of LA, Long Beach, on the East Coast, Charleston, Savannah, in the Gulf Coast, Houston, coming online with Port of Mobile, they're really doing a heroic job. And I wanted to bring this point out of what the heroics of what's been done at the ports of LA and Long Beach, because all you hear on the news is, wow, it's all backed up. It's a cluster. There's too many containers congesting. They're all stacked up. It's not the port's problem. It's someone else's problem. And if they would focus on this amazing accomplishment. So it's going to be better for us than the rest of the world. It's going to be atrocious in Europe. It's going to be atrocious in China. The Chinese New Year may be in real trouble because it can't get all those fresh fruit and vegetables and apples and everything out of the Pacific Northwest and Oregon and Washington for their Chinese New Year. But no, this is not going to alleviate anytime soon. And I think it's going to get compounded by companies making decisions on site selection. So one of my didn't put in was Hyundai. Hyundai recently announced that it is going all in on moving all of its supply chain to North America. Everything electric vehicle, whatnot, they're going to put over $7 billion in investments in new factories, new warehouses. And it's not just because they're worried about their neighbor to the north. They understand we're their largest customer. They understand that we're the safest place to do logistics and move things and consume goods. So Hyundai is a real proxy for what's going to come. This is going to take 2 or 3 years to unwind. And I fear the Fed doesn't get this. And this is what happened in 1977 to 81. What we have that's parallel to today is we came out of the 60s with deficit spending for Vietnam. Then we had Nixon put price controls in place to try to cover up inflation, kind of like what the Fed's doing with its balance sheet. We then had a major energy disruption with an oil embargo and energy prices quadrupling and whatnot and bleeding all the way through the economy. So by the time, then we had a political crisis, kind of like we have now. So we had Watergate and Gerald Ford had to take care of all that. By the time all of that just got pushed aside and we brought in a new president, Jimmy Carter, really nice guy, but they didn't teach economics in submarine command school. And he came in and didn't have a clue. He was a deer in the headlights on the economics, had a Fed chair that said there's only one solution: shut the whole economy down, take interest rates to 21%. Now think about today. Then it was energy, and it was a masking of inflation. We have the Fed monetary and fiscal policy masking inflation, intervening in the market, and we have supply chain causing the inflation. And the supply chain, just like the energy problem, didn't go away right away. It took years to unwind it. So I think this is a longer term problem. What it means for CCIMs is commercial real estate prices are going up. We're going to need to be sharper on our skills. We're going to need to be sharper on using site to do business in more than retail analysis, but things like office and logistics. And I think it's a longer term problem.
Wow.
Did I cheer you up?
Yeah, no, not at all. And it's a lot to think about. And, it seems like there's such a demand and a lack of supply and we have such a labor shortage. And, some of that seems like it's artificial. We all have friends in business that can't get employees to work in their stores and in their shops, and is there a reason for that beyond just the unemployment? I mean, is the insurance? I mean, is the rent moratorium fueling that? And should we be? What should the Fed be doing to get people to go back to work? I mean, how do we change that?
Really important question. In fact, I traveled down to the Gulf Coast and stayed in a nice resort for a conference a week or 10 days ago. In 2 of the 4 days we were there, none of the restaurants could open up, not even the bar at the pool and the beach, because they had no workers show up. It's more than just that people are getting good stimulus checks and benefits, and it's tax-free, and maybe they're net better off in retail and hospitality, not going back to work. Is more complicated than that. It's complicated because what do you do about childcare, kids back to school? Those things have to come into place. We're in summer, kids are out for the summer. We still don't know what school districts are going to do. We still have an unknown here in my market in Atlanta and many other locations. So it's a combination of what we need childcare back on track and support there. And then a lot of folks have taken advantage of these subsidies during COVID, and rent and mortgage forbearance are one of those. 1 in 4 American households have not been paying their rent or mortgage. And that all comes to an end later this year or next year, unless we do mortgage forgiveness and rent forgiveness, which I think is coming. And so when you look at the compound effect of my stimulus check goes away, my tax credit that I'm getting monthly for this next year goes away, childcare costs are going to go up because I have to pay more to hire people, or they may not, and there may be shortages of it. But now I got to start paying my rent and mortgage, which I hadn't been thinking about for the last 12 months. So it's a real challenge. And then the other thing that we're finding in markets like San Francisco, New York, Seattle, LA, is a lot of this workforce has left. The great chefs at restaurants and whatnot have left, and they've gone to, say, Phoenix, and they're working at the Arizona Biltmore in Scottsdale, or they've gone to Hawaii because Hawaii's opened and really a cool place to be. And so a lot of this workforce, New York wants to open restaurants, but they can't because they can't get the waiters, the waitresses, the cooks. They've all left and they moved elsewhere. So that's another piece of this. And the Fed can't solve all these problems. It's got to quit trying to be I'll solve everything entity, and it needs to put some of this back on governors and Congress. And I think there's not a lot of political courage on either party to basically do those tough things. If we don't do it, we've got 1970s style inflation. What follows was not pretty. I hope we get it under control now and bite the bullet, but it's a complex compound problem, and it's not just that people are getting paid too much stimulus.
Wow. Maybe if people would go back to work, they could start paying their rent.
Old guys like me are going to get 2 and 3 jobs so I can keep paying for those millennials. The good job, my millennials have gotten employed. And so, they couldn't get jobs post the Great Recession. So they went to grad school, took on student loan debt. And so the good news is they're getting employed, but now they can't afford an apartment or to buy a place. So they're coming to mom and dad asking for 20, 50, 75 grand or a loan or to co-sign. So I'm going to have to keep working probably into my 80s to pay for, because I don't want them to come back. I got them out of the house. I got them employed. I will pay to let them have their own apartment. I will help them out.
Wow. It really seems like it's the tale of 2 worlds, with some areas are doing great and other areas are just really getting hammered, and with the migration. Well, I'm being told that we're out of time. I'm sorry we couldn't get to all the questions. K.C., once again, thank you for sharing your expertise with us today on this webinar. And thank you to everyone that was here with us for attending. And as a reminder, the recording is available, and we will be sending it out to all the people that were registered for the event. And if you're not already a CCIM Institute member or a course participant, take a moment to sign up for our e-newsletter at ccim.com to stay informed about the complimentary webinars like this and others, as well as professional development opportunities. If you're not yet a member, please also join your local chapter. And there's a lot more great programs and networking events out there that CCIM is putting together every day all over Region 2, thank you for helping us put this event together, and thank you everyone. And K.C. again, have a great day, everyone.